All right, let's dive right into this explainer. Today, we're taking aerospace and defense titan Lockheed Martin and putting it through the absolute ultimate fundamental analysis gauntlet. We're stepping into the shoes of expert investment analysts, taking all their raw financial data and running it through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Then, we'll compare those classic views against modern Wall Street valuation models. It's essentially the ultimate stress test for a stock.
Here's our game plan for today. First, a company snapshot. Second, the Buffett lens. Third, the Lynch lens. Fourth, the Graham lens. Fifth, DCF and alternative models. And finally, number 6, our final verdict.
Section 1. Company Snapshot.
So what are we actually looking at here? We're analyzing Lockheed Martin, ticker symbol LMT. This is a massive $123.44 billion global defense contractor. If you follow global defense at all, or honestly just watch the evening news, you know they are the primary architects behind some seriously critical platforms. Think the F-35 fighter jet, the PAC-3, and THAAD missile interceptors. Basically, they generate their revenue by designing and building advanced aerospace and defense tech, mostly for the U.S. Department of Defense and allied governments. Now, currently trading at $535.38 a share, this company presents a really fascinating financial tug-of-war. On one hand, they are sitting on a record $194 billion contract backlog. That is literally a massive pipeline of guaranteed future work. But on the flip side, we're seeing this troubling recent compression in their net profit margins. They've been squeezed down to just 6.4%. So they've got record demand, right? But they're kind of struggling to convert that efficiently into actual bottom-line profit.
Section 2. The Buffett lens.
Okay, let's look at this through the eyes of the Oracle of Omaha. The crucial point here is that Lockheed has an undeniable, massive economic moat. I mean, competitors can't exactly just spin up a rival F-35 program in their garage overnight, right? And they boast an absolutely stellar 67.6% return on equity. But the rest of the picture is a bit mixed. Buffett demands consistent earnings and manageable debt. Right now, Lockheed's balance sheet carries high leverage risks, plus a pretty concerning 5.6% annualized decline in trailing earnings over the last 5 years. Because of these cost issues and the margin compression we just talked about, Buffett would definitely demand a strict margin of safety, probably at least 25% below intrinsic value before even thinking about buying.
And this slide brilliantly illustrates Buffett's absolute favorite metric, owner earnings. This metric cuts through all the accounting noise and shows you the actual, usable cash a business generates for its owners. If we take 2025's robust operating cash flow of roughly $8.56 billion and subtract the $1.65 billion required for capital expenditures, we see Lockheed generated a super healthy $6.9 billion in approximate owner earnings. Buffett would absolutely love that raw cash generation. But again, that heavy debt burden, that would likely keep him on the sidelines.
Section 3. The Lynch lens. Next up, Peter Lynch. He famously popularized the PEG ratio to spot bargains. It's pretty straightforward. You take the traditional price-to-earnings ratio and divide it by the company's earnings growth rate. Lynch generally looked for a PEG ratio under 1.0, which tells you the stock is trading at a discount relative to its actual growth.
Now, what is really wild about this next slide is Lockheed's highly unusual PEG ratio. It's sitting at negative 2.3x. Why negative? Well, it stems from those historically shrinking trailing earnings we mentioned, that 5.6% decline, clashing head-on against Wall Street's projected future earnings growth of 12.4%. For a Lynch analysis, seeing a negative PEG ratio on a mature company like this is a massive red flag. It essentially means their historical growth trend is fundamentally broken at the moment.
Furthermore, we have to categorize the company. Lynch loved finding fast growers, or those hidden asset plays that had really low institutional ownership. Lockheed is literally the exact opposite of that. It's a slow-growing stalwart with massive, heavy-hitting institutional backing. So combining that high institutional ownership, the lack of a bulletproof balance sheet, and that negative PEG ratio, Lynch's criteria would likely trigger a hard sell or avoid rating, at least until their earnings growth actually stabilizes and proves itself.
Section 4. The Graham lens.
Let's run Lockheed through Benjamin Graham's famously strict defensive investor checklist. It's actually a split decision here. It easily passes on adequate size with its $123 billion market cap, and it passes on the dividend record, offering a super reliable 2.69% yield that just paid out over $800 million in a single quarter. Not too shabby. But it completely fails on Graham's strict requirement for a strong financial condition because of that high debt. And it only gets a mixed grade on earnings stability due to the recent uneven profitability we've seen.
But here is Graham's ultimate test, his intrinsic value formula. If we take the square root of 22.5, multiply it by the trailing EPS of $20.70, and then by the assumed book value per share of roughly $32.56, we get a brutally low fair value estimate of just $123.14. Think about that. With the stock currently trading in the $530, there is absolutely zero margin of safety here. Benjamin Graham would probably run out of the room screaming at this current price.
Section 5, DCF and Alternatives Models. All right, here is where the narrative completely flips. If we assume the bullish story holds true, meaning supply chain issues get resolved and Lockheed actually hits that projected 12.4% annual earnings growth through massive demand for platforms like the F-35, our base case DCF model paints a very different picture. Assuming a weighted average cost of capital around 7.5% and a 2% terminal growth rate, it prices the stock's fair value at roughly $643. Now remember, DCF models are highly sensitive. If you tweak that WACC even slightly, it alters the intrinsic value dramatically. Still, going by this modern model, it suggests the stock is essentially 20% undervalued today. Modern Wall Street cares about future cash, not historical stumbles. And supporting this more modern, bullish view, an alternative comparable valuation model shows Lockheed trading at a price-to-earnings multiple of just 24.7x. Just look at this steep discount here compared to the broader aerospace industry average of 37.4x. It's an even bigger discount compared to its direct peers, which are trading way up at nearly 50x earnings. Plus, if we apply a second valuation model, like EV to EBITDA, a very similar discount story emerges. So by modern relative standards, Lockheed actually looks kind of cheap. Section 6, Final Verdict and Synthesis. This summary table perfectly captures the wild debate we've uncovered today. On one side, you have deep value purists like Graham and Lynch. They see a stock weighed down by leverage, high institutional ownership, and shrinking historical margins, which triggers some very clear sells for them. But on the other side, modern DCF models and Wall Street analysts look at the very same company and see a discounted giant sitting on a $194 billion backlog that's just ready to recover, triggering buys with targets up in the 600s. So what's the bottom line? Ultimately, looking at this balance of strengths and risks, our blended expert verdict for this explainer is a hold. Yes, the company generates incredible cash. We're talking nearly $7 billion in owner earnings, and it builds absolutely vital global defense tech. But until we see hard evidence in their quarterly reports that they can actually stop this margin compression and handle their heavy debt burden, the risk simply isn't priced in well enough to satisfy those legendary investing frameworks. So I'm going to leave you with this question. Knowing the massive clash between Graham's strict mathematical realities and modern Wall Street's highly optimistic growth targets, at what specific price does Lockheed Martin finally enter your personal margin of safety? Dive into the numbers, weigh that massive backlog against the debt, and decide for yourself.